The Pittsburgh Business Report is provided free to the public with contributions from Doug Farrell, makeup artist, Sephora of the South Hills Village Mall, Sabika Jewelry, the Post Office Catering Group, Allure Hair Designs and Mini Spa, Viewpoint Studios.
Welcome to the Pittsburgh Business Report. I'm Donna Klein. Today we're going to discuss personal finances. And to help us delve into this subject matter, we have our guest today from BCR Financial Services, Mark Reichel. Thank you very much for being here.
Thank you for inviting me.
Shedding some light on investments. It's been a very volatile time in the markets recently. If I am just now starting to invest in the market, say I just graduated from school, maybe I have some debt, what do you recommend how I get started investing for retirement?
Well, if you're starting to look at retirement right out of school, first of all, I'm going to compliment you because most people graduate and they're interested in buying things. That's a little bit more fun, obviously, than saving for retirement. The main thing that you need to do is you have to look at your age. And the younger you are, you can do small things at the beginning, save a little bit here, a little bit there, basically put yourself on a really easy path to accumulating money for the long term. Because it's not about how much money you can save monthly at the beginning, it's how long you have to save. So if you're graduating, you have some debt, you want to obviously pay that down some, enjoy some of the rewards of the hard work, and then be able to put a little bit of money away monthly, and over time you'd be amazed at the amount that it'll actually grow to.
Now, should I be thinking of maxing out a 401k right out of the gates?
Right out of the gates, boy, you're really just aiming for retirement here. Most people don't know what the 401k is. First of all, if you just graduated from college and you get a job, most companies these days offer what's called 401k, which is a retirement plan that's offered through your employer. Larger companies have them almost all the time. Smaller companies do as well. What you do is you save into a 401k first and foremost to provide money for retirement. As most of us know, getting out of college, you might not know that. The nicest thing is you actually get a tax break on the money that goes into your retirement plan. So to put money in there saves you a lot of money on taxes, which is wonderful, but you don't want to have every penny in an investment account that is designed to be accessed in retirement. Let's say 59 and a half is the magic date the government has on that. You want to have some money set aside that you can get to in an emergency or an opportunity. If you get married, have children, want to buy something else. So should you max it out? Depends on how much money you make. Should you put money into it? Without a doubt. Should you save into some accounts that are accessible monthly? Or if you needed it in an emergency, you should do that as well.
Now, is that on the same lines as starting an IRA?
Well, an IRA is an individual retirement account. You can save monthly, you can save annually into it. They work the same way if you have the deductibility. There are different plans that are available, and depending on what income you make, you can save into an IRA, you can save into a 401k, but for purposes of the conversation, the benefit's the same. You get a tax deduction for the money you put in your IRA. It comes off of your tax return, and you're able to save that money then tax deferred.
If someone's looking to buy a house now 10 years out of school, what percentage of their income do you think they could comfortably be putting towards a mortgage? I know you're not a mortgage broker, but just an idea.
Yeah, no, that's a good question. If you look at the guidelines to acquire a mortgage, you're able to use 28% of your pay on a monthly basis to qualify for a mortgage. So if you figure you're paying X amount of dollars percentage-wise in taxes, you have to pay your bills, you have to pay utilities. The rules say you can spend 28% of your income. You decide as a shopper if that's the right number or not, but guidelines, you can get approved for that. Mm-hmm. Obviously, somebody that's selling you the house is going to show you the house that you want, and it's very attractive to get a bigger house. It's more exciting, more fun, but you have to be careful of that. Now, from a debt standpoint, if you've got solid credit and you have a good nest egg, they will sometimes allow you to go up to actually 35% of your monthly income in a mortgage payment. You have to remember that's principal and interest, that includes taxes, so the numbers get up there pretty quickly. The biggest benefit to buying a mortgage these days is that the interest rates are incredibly low. So when you look at the homes that were built in the 80s, and they weren't that large, but interest rates were 15 and 17%, the reason the homes weren't that large is because nobody could afford that monthly payment. There's a huge advantage right now to getting a mortgage at these rates that are 4.75, 5% on 30-year fixed loans.
Right.
You can buy a lot more house with a much smaller payment.
So you're a homeowner now. You've been a homeowner for 10 years. You have a family. Kids are getting ready to go to school now. You're getting closer to hopefully retirement. You've been working for some time. How do you change your assets? What's starting to change for you investment-wise?
Well, I think as you mature, we'll say, as you get older and you have more things that you have to worry about. You have to worry about retirement. It's getting a little bit closer. Hopefully you've been saving for college, or for your children for college. What happens with investments is they become a little bit more predictable in where you need to allocate money. So your earlier question about graduating from college, you just want to save money. Put some money in there. It'll grow for you. It'll reward you down the pike. You're going to be very happy with that. Well, as you mature and you have different goals or more specific goals, then you need to be allocating money towards specific investments. So you're going to want to rely more on that retirement plan, whether it's an IRA or a 401k at work. You're going to hopefully be able to, if you have children, be looking at saving for their college. And there are more unique investments these days, like a Section 529 college fund, where you can save into that investment and that money then grows tax-free for college. So what happens as you get older is you literally have different investments that you need to take down for goals. So you're going to have a retirement goal or a college goal.
A 529, is that something you should start when your children are born?
Well, if you want to make it easy on yourself, yes. The problem with saving these days for college is very expensive, as we all know. Anybody that's writing checks these days, they know how much it costs. If you want to send your kid to a CMU type of college, you need to save at birth now in and around $500, $550 a month. To save that. Save for college when you're looking at your new baby who is 1 month old.
My goodness.
It's staggering.
Would you say then, what's the most important thing about investing? Should I always be looking to avoid the tax man? Am I always looking for, growth? I mean, if you had one main rule for an investor?
One main rule for an investor, I would have to say that's to remain calm. Okay, what happens these days, media puts out information so quickly. 20 years ago, something happened in China, nobody knew about it, or it took a long time to get out. The main thing that investors have to do these days is they have to remember that they made a specific investment, or they should have made a specific investment for a specific period of time. And if that investment is invested for 2 weeks from now, that investment shouldn't change because it's in a cash account. If you're investing for something that's 30 years down the road, you need to remember that tomorrow's news doesn't affect your time horizon of 30 years. So investors need to continue to remain calm and let the investment professionals that help them manage their money and not overreact, which is what we see a lot these days.
Well, you mentioned that you are an investment professional. That's what you do. You help people with their money. If someone is looking for a professional like yourself to work with, not everybody is trustworthy. What's the first thing they start to look for in an investment professional? I mean, should they check their background? Should they check a track record? How do they know that this person's going to treat them right and treat their money fairly?
Well, there are ways that you can look up an investment professional's credentials or their history, different avenues that you can go on a website through agencies. There's an agency called FINRA that you can log on, FINRA, and you would look at them and you can actually type in information on an advisor and see if they have problems or if they've had a complaint against them. Probably the main thing that you need to do is talk to your friends. Find somebody that you think is educated, good with their money, and ask them who they're working with. It's the best way that you can get introduced to a financial advisor, because if I meet you for the first time, I'm going to tell you all these great things that I can do for you. And talk is cheap. We know that. So the question is, how do you pick somebody today that you believe or you feel they're going to be doing the same things for you 10 years down the road? So my recommendation is always to talk to some of your peers that you think are educated and a good person to get a referral from, and ask them who they work with. That's probably your best way to start.
Thank you, Mark, for being here today. That's been our guest, Mark Reichel of BCR Financial Services. For more information on our guests or upcoming shows, search for the Pittsburgh Business Report online at YouTube or Facebook.